For years, they were the fortress of traditional finance, the gatekeepers who looked at Bitcoin and sneered, while BlackRock, Fidelity, and practically everyone else on Wall Street was scrambling to build crypto products. This $11 trillion giant stood firm. They blocked you from buying Bitcoin ETFs. They told you crypto had, quote, no intrinsic value. They effectively told 50 million clients that if they wanted digital assets, they could go take a hike. Well, guess what? They just blinked. In a move that has stunned the financial world, Vanguard, the second largest asset manager on the planet, has officially capitulated. As of Tuesday, December 2nd, the ban is lifted. The floodgates are open, and the implications for your portfolio are potentially massive. Is this the start of the institutional supercycle that we've been waiting for? Or is this the ultimate top signal, the moment the last bear finally throws in the towel right before the crash? Today, we're breaking down exactly what just happened at Vanguard. We're going to look at the internal coup that replaced a crypto-hating CEO with a BlackRock veteran. We'll analyze the immediate price reaction that saw Bitcoin claim $91,000, and we will answer the trillion-dollar question. Now that the herd is here, are you front-running them or are you becoming their exit liquidity? My name is Louis, and this is the Coin Bureau. Now, before we dive into the belly of the institutional beast, I need to remind you that I am not a financial advisor. I am just a guy on the internet reading the tea leaves of the financial elite, so you don't have to. This video is for educational and entertainment purposes only. And if you want to see us cover more breaking institutional news like this, well, prove it by smashing that like button until it capitulates just like Vanguard did. Let's start with the news itself, because if you blinked, you might have missed the magnitude of this shift. On Monday, reports broke out that Vanguard was reversing its long-standing ban on cryptocurrency products. By Tuesday morning, December 2nd, it was official. Vanguard's 50 million brokerage clients can now trade eligible crypto ETFs and mutual funds. And we aren't just talking about Bitcoin here. This policy change covers funds holding Ethereum, Solana, and XRP. Just let that sink in for a second. We are talking about an asset manager with over $11 trillion in assets under management. For context, that is roughly 4 times the GDP of the United Kingdom. Until this week, that entire mountain of capital was effectively gated off from the crypto ecosystem. If you had a Vanguard retirement account, or if you were one of their 8 million self-directed brokerage clients, you were blocked. You got an error message. It was a hard no. Remember January 2024, when the spot Bitcoin ETFs launched and broke every record in history? Vanguard was the only major player that refused to play ball. That triggered a massive backlash. The hashtag #BoycottVanguard was trending. Customers were closing accounts in droves, moving their funds to Fidelity and Schwab. At the time, Vanguard didn't care. They were the adults in the room. They were protecting you from yourself. So, what changed? Did Bitcoin suddenly gain intrinsic value overnight? Did the volatility that they were so worried about magically disappear? Well, no. What changed was the leadership. And this is where the story gets really interesting. It turns out this wasn't just a policy change. It was a regime change. To understand why this happened, you have to look at the top of the food chain. The man responsible for the anti-crypto blockade was former CEO Tim Buckley. Buckley was a Vanguard lifer. He spent 33 years at the company. And he hated crypto. He was the one who famously said that cryptocurrencies, quote, lack intrinsic economic value and generate no cash flows. He called Bitcoin, quote, too volatile and said it didn't belong in a long-term portfolio. Under his watch, no crypto was a matter of principle and ideology. But Wall Street doesn't care about ideology. Wall Street cares about fees. And while Vanguard was standing on principle, BlackRock was scooping up billions in assets with their IBIT ETF. So, what did the Vanguard board do? Well, they showed Buckley the door. He retired, and in July 2024, they brought in a new CEO. And they didn't promote it from within. For the first time in their 50-year history, they hired an outsider. Enter Salim Ramji. And where did Salim come from? Oh, you know, just a little firm called BlackRock. You can't make this stuff up. Salim Ramji wasn't just at BlackRock. He was the global head of iShares. He was literally the guy who oversaw the filing and logistics for the launch of the Bitcoin ETF. He is the architect of BlackRock's crypto strategy, and now he's running Vanguard. When he took over in July, everyone expected an immediate pivot. But Ramji is smart, and he played it cool. In August 2024, he gave interviews saying Vanguard, quote, will not be launching crypto ETFs. He kept the moratorium in place for over a year. He waited. He let the dust settle. And then, just as Bitcoin was recovering from that brutal November flush, he pulled the trigger. Now, let's talk about the market's reaction, because there is a lot of noise out there. If you looked at Twitter, you might think this news sent Bitcoin to the moon instantly. The reality is a bit more nuanced, but arguably more bullish. On Monday, December 1st, Bitcoin was actually tanking. We saw a sharp drop down to the 85,800 level. It looked ugly. The bears were out in force, calling for a return to 70K. Then the Vanguard news started to circulate. And on Tuesday, December 2nd, the first day Vanguard clients could actually click buy, Bitcoin ripped. It rebounded by over 7% in 24 hours, reclaiming the $91,000 level. Now, was this entirely due to Vanguard? Well, probably not. We also have the Fed meeting coming up, and the markets are pricing in an 85% chance of a rate cut. The macro winds are shifting. But you cannot ignore the timing. Bloomberg ETF analyst Eric Balchunas noted that the jump at the US market open coincided perfectly with the lifting of the ban. And it wasn't just price either. While we can't justify some of the wild rumors about the $1 billion in 30 minutes volume surge, be careful with what you read on X, folks. We do know that this reversal comes after a brutal month of outflows. In November, we saw record outflows from spot Bitcoin ETFs. Over $3.6 billion left the ecosystem. The sentiment was honestly terrible. And right when maximum pain was hitting, right when everyone was bearish, Vanguard steps in. Coincidence? I think not. But here's the kicker. It wasn't just Vanguard. If this was just one company changing its mind, that would be big. But what we are seeing is a coordinated shift across the entire banking sector. While everyone was focused on the Vanguard news, another massive bombshell dropped on the exact same day. Bank of America. Yes, the bank that has historically been one of the most conservative anti-crypto institutions in the US just updated their guidance. According to reports verified on December 2nd, Bank of America is now telling its wealth management advisors that they can recommend a crypto allocation of between 1% and 4%. 1 to 4%. Do you realize how much money that is? Bank of America manages over $3 trillion in client assets. A 1% allocation across the board is $30 billion of buying pressure. A 4% allocation is $120 billion. That is more than the entire market cap of Tether. And they aren't alone. Let's look at the scorecard. Fidelity? Well, they've been in the game for years. Morgan Stanley? They opened up universal access to all clients back in October. Charles Schwab? They're planning direct crypto trading by mid-2026. And now Vanguard and Bank of America have capitulated. So, who's left? Well, you got Wells Fargo, Goldman Sachs, and UBS holding out. That's it. The list of bears is shrinking faster than the value of the dollar. But before we get into what this means for the price of your bags and whether this is the start of the super cycle, I want to talk about how you can position yourself for this shift. Because while the institutions are buying ETFs, the real gains often come from being nimble. If you want to trade this volatility, or if you want to just front run the next bank to capitulate, well, you need a reliable exchange. And that is where the Coin Bureau Deals page comes in. We have curated the absolute best sign-up bonuses, fee discounts, and exclusive offers from the top exchanges in the industry. We are talking about deposit bonuses that could go up to $100,000 for high-volume traders. We have trading fee discounts of up to 50%, which is massive if you are active in this choppy market. We have deposit cashbacks of up to 75%. Whether you're looking for a new home for your trading stack or just want to grab some free crypto, these deals are designed to give you a head start. The institutions are getting their deals behind closed doors. This is how you get yours. So hit that link in the description below or scan the QR code on the screen right now. It helps support the channel and put some extra crypto in your pocket. These offers rotate regularly, so make sure you take advantage of them while they last. Okay, now back to Vanguard, because there is a specific reason why this particular capitulation is more important than just number go up. It has to do with the type of money Vanguard manages. You see, Vanguard clients aren't day traders. They aren't apes leveraging 100x on Pepe. They're your parents, they're pension funds, they're passive index investors. They buy and they hold, a lot of times forever. This introduces a concept called the passive bid. Here is how it works. In a standard diversified portfolio, you set a target allocation. Let's say, thanks to Bank of America's new advice, the target is 2% Bitcoin. If the price of Bitcoin crashes, your allocation drops to 1%. What does this automated portfolio software do? Well, it buys more Bitcoin to get back to 2%. It forces buying into weakness. Conversely, if Bitcoin rallies to the moon and becomes 5% of the portfolio, then it sells some to get back to 2%. This sounds boring, right? But it is revolutionary for crypto. Bitcoin has historically been driven by manic retail flows. We buy when it's green, we panic sell when it's red. That creates those wild 80% drawdowns. The Vanguard crowd brings in price-agnostic capital. They don't care about the chart. They care about the allocation. This creates a permanent price floor. It creates a structural bid that is always there, absorbing the selling pressure from miners and paper hands. This is exactly what happened with gold. When the gold ETF launched in 2004, it didn't just pump the price, it changed the market structure. It dampened the downside volatility because there was always a passive bid waiting to scoop up cheap ounces. Vanguard opening the door to 50 million clients who hold $11 trillion, means that even a tiny penetration rate, say 0.1% of those assets moving into crypto, implies billions of dollars of sticky, permanent inflows. So this begs the question, what happens next? Well, first, let's address the elephant in the room. Will Vanguard launch their own Bitcoin ETF? Officially, they say no. Their head of brokerage, Andrew Kajewski, stated explicitly that they have, quote, no plans to launch their own product. They're happy to let BlackRock and Fidelity take the risk and the regulatory heat while they just collect the trading fees. And honestly, that makes sense. Vanguard is conservative. They follow, they don't lead. They waited until gold ETFs were mainstream before adding them. And they are doing the same here. I wouldn't expect a Vanguard Bitcoin Trust until at least 2027 or maybe 2028. But that doesn't matter. The gateway is open. The bigger question is this the top? You'll hear a lot of people saying, when the last bear capitulates, the top is in. It's a classic contrarian signal. Even if the haters are buying, who is left to buy? I think that view is wrong, and here's why. Let's look at gold again. The first US gold ETF launched in November of 2004. Gold was trading at $700. Did it drop? No. It went on a 7-year run to $1,900. The launch of the ETF wasn't the end of the trade. It was the start of the financialization of the asset. It was the moment gold moved from being a niche rock for doomsday preppers to a standard portfolio asset. And we are seeing the same exact thing with Bitcoin. We are transitioning from the early adopter phase to the early majority phase. Matt Hogan from Bitwise calls this the institutional supercycle. He argues that the traditional 4-year halving cycles are dying. They are being replaced by a new driver, institutional adoption. I mean, think about it. We have the halving supply shock. We have corporate treasuries like MicroStrategy buying every dip. And now we have the passive bid from the world's largest asset managers coming online. These are the 3 massive structural drivers that didn't exist in 2017 or 2020. However, and this is a big however, don't think this means up only in a straight line. Bitcoin is currently trading around $92,000. It is still down about 30% from its all-time high in October. The market is skittish. We just saw a massive flush in November. The Vanguard news is bullish fundamentally, but in the short term, the market is still wrestling with macroeconomics, recession fears, and the fact that we rallied so hard, so fast earlier this year. So, what is the verdict? Vanguard's capitulation is a psychological milestone. It is the final validation that crypto is not going away. When the firm that manages the retirement savings of half of America says, okay, you could buy this, the stigma is gone. Wall Street isn't just coming. They have kicked the door down, rearranged the furniture, and are now sitting at the head of the table. The question you have to ask yourself is this: are you positioning yourself ahead of this passive wall of money? Or are you going to wait until your 401k auto-allocates into Bitcoin at $500,000? The institutions are moving. The herd is here. For the first time in history, the retail investor, you and me, we actually got a head start. Don't squander it. But what do you think? Is Vanguard's entry the start of the super cycle? Or is this the ultimate top signal before a recession nukes everything? I want to hear your best theories in the comments below. And if you want to know about which banks are still secretly accumulating crypto while telling you not to buy, well, you should check out that video right over here. My name is Lewis, and this has been the Coin Bureau. Thanks again for watching, and I'll see you in the next one.